The next is accrued receivables or accrued revenues. Different book have different terms. This involves situations when revenue is recognized while the cash receipts will be in the next accounting cycle. So the adjusting journal entry for accrued revenue or accrued receivable will be we will debit accounts receivable and credit revenue. We should recognize revenue in current accounting period, even the company does not receive cash. The cash payments will be received later. So we debit an asset, which is accounts receivable, and credit revenue. The adjusting journal entry of accrued receivable will increase revenue, so earning will increase. The impact on the balance sheet, assets increase because we debit assets. Retained earnings increase because we credit revenue. Example, accrued interest revenue. So here, the company is a creditor, the lender. This example is for the same company, Dress Right, but it is for August. Okay, so this example is independent from the prior example. Prior example are all journal entries, adjusting journal entries in July, right? At the beginning of August, the first day of August, this company lent another company $30,000. That's a principal. Our interest is 8% for 3 months. So that's a short-term loan, 3 months duration. By the end of August 31st, we should accrue the interest revenue or interest receivable for this company. When the time lapse, the company will incur interest expense as a borrower. It also recognizes interest revenue as a lender. So we will debit interest receivable, which will be received 3 months later when this note receivable is due, and also recognize interest revenue, even there's no cash received. And the amount based on the calculation is principal multiplied the annual interest rate for 1 month, because that's the interest revenue for August, 1/12, $200. Receivable here for interest is interest receivable. For revenue, it is interest revenue. And then later, the cash inflow or cash receipts follows this adjusting journal entry. 3 months later, the company, the Dress Right, will receive the principal and plus 3 months interest in cash payments. These are all 4 types of adjusting journal entries. That is also step 6. After this adjustment, similar to the step 4, we will post the journal entry information to the ledger again. Then we will have adjust the trial balance. That's step 7, which is the second trial balance after step 5.